Markets can look strongest right before the constraints start tightening. The real question is not whether growth can run hot. It is how long it can run hot before the funding system pushes back. At the recent conference discussion with Stephanie Pomboy, the shared thread was not prediction, it was sequencing. Policymakers can create a near-term sugar rush through tax refunds, deregulation, and front-loaded stimulus. That can lift headline GDP, support asset prices, and keep confidence elevated into the midterm window. But stimulus does not operate in a vacuum. It lands on top of commodity trends, oil prices, and an already large deficit that must be financed. Here is the mechanism we are watching. If growth surprises to the upside, while inflation inputs firm at the same time, the bond market becomes the enforcement arm. Not because it has a view, because it must clear supply. If long yields begin to rise persistently, financial conditions tighten even if the policy rate is stable or drifting lower. Mortgages reprice. Corporate refinancing costs increase. Equity multiples compress. That is how late-cycle strength can quietly morph into late-cycle fragility. We are also watching behavioral transmission channels. Retail gasoline prices have shown an unusually tight relationship with consumer confidence in recent years. If energy edges higher, confidence can soften quickly. In a K-shaped economy where the top half drives spending through asset appreciation, a meaningful market correction feeds directly back into growth. Another theme raised was institutional friction. Even if a future Federal Reserve chair is perceived as hawkish, the system itself has inertia. Committee dynamics, political pressure, and financial stability considerations limit how far and how fast policy can shift. So rather than focusing on personalities, we focus on observable signals: auction demand, term premium, credit spreads, liquidity conditions. There was also discussion around stablecoin reserve structures as a potential new liquidity channel. We do not need to assume intent. We only need to observe whether these structures change marginal demand for short-duration government collateral or accelerate the speed of liquidity distribution. If they do, that affects sequencing. If they do not, the traditional funding constraints remain dominant. Our base case remains late-cycle resilience with rising constraint risk. We assign roughly a 65% probability that risk assets remain supported in the near term while pressure builds underneath. We assign roughly a 25% probability that multiple compression and defensive rotation begin to dominate as yields push higher. And we assign a smaller but meaningful probability that by late cycle, credit stress becomes the primary driver. If you find this type of probability-based, mechanism-first analysis helpful, consider subscribing. It allows you to follow the evolving signals in real time, understand how phases transition, and stay grounded in process rather than headlines. Quick note: this content is for educational purposes only and is not investment advice. What would confirm rising stress? A sustained move higher in long-term yields alongside firm commodities, widening credit spreads, and weakening confidence. What would invalidate it? Stable or falling long yields, contained credit spreads, and clear evidence that inflation pressure is fading without disrupting growth. We are not here to predict outcomes. We are here to identify the hinges, watch the sequence, and preserve optionality as conditions evolve.